Thanks so much for showing up today, everybody. It's my honor and pleasure to be joined by Danielle Park, one of my absolute favorite analysts in the space that I follow. I never miss her work. I never miss her writing. She is a truth teller and has an amazing ability to cut through hyperbole and noise and get to what's really occurring in the markets. And so, Danielle, thanks so much for joining me on stage today.
My absolute pleasure. Thanks, Jay.
So here's where I want to start. This morning I gave a talk and I began with a bit of a bleak picture of Canada today. But I wanted to make a point that this is a recent trajectory for us relative to where we were back in 2008. Do you think I'm being, and then I say, I think we're actually at a very consequential moment because things have been very good. I don't think things are very good right now. I believe a tipping point is in front of us. Do you think I'm being over dramatic? What's your take? And share your perspective on that. We'll start there, and then I'm going to pull on some threads.
Yeah, I think your talk was very good and very thought-provoking. Yeah, and I think the word of the day is fascinating. This is what I'm feeling right now as I look into the changing government in the United States this week and the shifts that are going on throughout the world. I think the next 30 and 90 days are going to be fascinating in the sense of this tipping point. Either we are at a place where we are going to start to see major changes in approach, or I think we are going to be in a very tumultuous period, well, either way. But basically, the two things that have been different in the last year is we had central banks cutting interest rates throughout the world, and for example, the U.S. Fed cutting, and what happened, treasury prices fell in the process, which is unprecedented pretty much, so interest rates went up. So I'm thinking to myself, what happens in a world where central banks can no longer push down the price of capital? And if we are in that world, debt matters again. So I don't think we're going to get back to the zero bound where we were, and that was such a destructive period, and I'm really happy we're not likely to get back to the zero bound. I thought it brought on a whole bunch of terrible habits. It brought on a whole bunch of disregard for money, a disregard for what investing was versus speculating, just really bad things. And we're living with the inflation that caused and the asset bubbles that caused. But we're also dealing with the environmental harms and impacts that have come from our consumption-based approach over the past many decades. So case in point, California, right? So the other thing that's going through my mind is, what if we're in a world where insurance is no longer affordable or widely available? And this cuts on a whole bunch of levels, Jay. So for example, healthcare. We know aging demographics. You were talking about mitochondria being the number one source of energy. I would submit to you it still is. We have been in a time where people could afford to allow their health to dilapidate because the system of insurance was there to catch them. What if we cannot afford that anymore? What if it starts to go back to self-insurance and self-reliance in many aspects of life, which we have become very complacent on? Financial markets have been incredibly complacent. Oh, don't worry, central banks will cut rates, we will all be bailed out, there'll be no problem. That has been the mentality of the past several decades, and I think we're at a tipping point in that. And so what matters most here is going to be efficiency, lack of waste. You mentioned about Elon Musk, Vice President Elon Musk has talked about, one of the policies in him as an electric car manufacturer is to remove subsidies for EVs. And people are saying, well, that's going to hurt Tesla. Well, not necessarily. Back to your point about competition. Who's making the best vehicles, and shouldn't that be part of who is getting orders and financing and all that stuff? So again, in this brave new world, perhaps governments are no longer responsible for subsidizing everything. Maybe they, of necessity, because of debt levels, because of normalized interest rates, because of demographics, which are no longer supportive of, ever and ever stockpiling of stuff to be paid for later, because we're starting to see the population change. So all of that suggests to me that we do need a whole new model, and we may be at that tipping point, and interest rates may be one of the things that's forcing that, but also insurance costs throughout the world. And the only thing I would take exception with in some of your comments at the start was this idea that oil and gas is not one of the most subsidized industries in the world. It is and has been, and also one of the most profitable. So my point would be, if we're going to remove subsidies on EVs and everything else that governments have been backstopping, we need to do that across the board. Let competition thrive. Let the best sources of energy come forward. Mr. Musk has also said that solar is the most readily available and obvious source for power throughout the world, and that's the thing that's going to drive most things. So again, in this transition, how can Canada harness that? How can we benefit from the need for investment in where we're going, not just in legacy industries in which we've depended on for many decades? So all of these are, I don't profess to have the answers to these. These are very challenging questions, but the idea that innovation, government's pulling back from this idea of insuring everyone and everything that's bankrupting us, basically, putting more self-reliance and self-insurance back into the puzzle. People will make a lot different choices. Industry will make a lot different choices. Finance will make different choices if they now bear the responsibility of their risk to a larger degree. And I don't think anyone would readily go there by, no politician would want to do that, but I'm saying perhaps at this point, when costs are now prohibitive, when people can't afford insurance, when we can't afford to add to debt, that's what I think the great change is, and I think we could be there now.
Thank you for that. Yes, please, thank you. I love the Brave New World concepts, and in a situation where we're no longer relying on the Fed to bail out the market, relying on the insurance companies to take care of our houses, relying on the FDA to take care of our food, all of these insurance policies, that's effectively what they are. But the bridge between here and there has got to be a bumpy one. Whenever you transition from one thing to the next, there's a period of volatility in the interim. And you're right, no politician's going to elect for that kind of change. They're going to elect for inertia, right? They're going to elect for the status quo. And so I want to pull on the thread of the trigger point from this to that. And you pointed to interest rates and the price of debts, but walk us through a bit deeper into that transition and the catalyst, Danielle, that could change the world in such a material way.
Well, so for example, the fact that, upwards of 15% of revenue, for example, in the U.S. is currently going to interest payments. So when they talk about how to cut spending, and at some point, again, this idea that central banks are these grand wizards that can control and support everything, that's been revealed to be false several times, but they've always sort of got the puck back after that, right? And I'm suggesting to you that every time the central banks have cut interest rates, primarily the Fed, but the Bank of Canada is basically along with that. But when they've cut interest rates, they have convinced everyone that that would be the solution, and that, asset prices will rally and everything becomes affordable again, because all we have to do now is extend and pretend and add to the line of credit. But that's not happening this time, right? And the world is awash in people. So money has to go somewhere, and as a money manager, this is the test. This is where the rubber hits the road. We have to put capital somewhere. Where are we going to put it in a world that's really replete with these asset bubbles, and in pretty much every area? We listened to the Bitcoin presentation. That might be true, that we may have a market for Bitcoin to continue. They've certainly bought political power in this last election, right? So maybe this is one of the obvious ways in which there's going to be diversification and capital flowing to different places. But I think that we have to be very careful that we don't presume, as I say, that the old... why has the United States market done so well in the past 10 years has been this AI transition, right? A handful of companies have really brought the whole thing along. Where did they get that money from? They got it from largely the tech boom that started in 2000, right? Like the Elon and bros were back then in some of the initial precursors to PayPal, and they had a bubble and a boom and a bust. So the tricky bit for capital is that theme, it has been dominant and continues, but that doesn't mean that people can just put capital there and not have it blow up. So these are the challenges. Like, for example, people don't appreciate that most stocks go down over time. That's just the reality of equities. Most equities go down over time. A handful of them will do well within a certain time frame. But stock markets spend 75% of their time going down and making back losses, and only 25% of the time actually making new gains. So this is just so complicated from an investment perspective, which is what most people look at, right? We like to talk about the economy. We like to talk about the political stuff. It's all very interesting. But how does this transpire in terms of financial impacts? And what I'm suggesting is that I think we have to spend less and save more. I think we have to get more efficient. The good news is AI and robotics and all these things are here now and galloping along to help us solve some of those problems. Innovation in commodity space, they're literally fabricating new materials. Pippa Malmgren was talking about that, whether it's carbon nanotubes, which as a competition for copper. So again, we have to be really careful that we don't presume that the old stuff is not going to be replaced, substituted, improved, and evolved, that efficiency is not going to allow us to do more for less, which I think is another major theme, that individual resourcefulness and self-insurance is not going to be a major theme. For example, if you can't get house insurance, how many of us will want a $2 million house? How many of us will choose to live in a more efficient abode? I think that's the future, and that's where we are right now. It's happening, it's evident in so many different ways. So I don't think I answered your question. It's just so complex.
Yeah, no doubt, and you did an excellent job. I actually want to pivot to a different subject right now. I want to ask you about the Canadian dollar. A lot of people in here, myself included, are feeling the pain of a weak Canadian dollar relative to the USD. And the concept of currency wars would say that countries fight to devalue their currency to make their exports more attractive and stimulate their economy. Could there be a case to be made that our weak dollar today inside of a commodity export country could end up being stimulative for us in the future?
Well, you alluded to it earlier this morning. Our currency is actually our commodity base, our rocks and trees. That's truly the Canadian currency, at least heretofore, right? That is how we've paid for everything else that we have. And so it makes sense to me that, with the venture exchange still below where it peaked in 2008, with the commodity resource sector having struggled for capital flows in this time where everything's gone to tech, a handful of tech has been that's captured everyone's imagination, they still need input. So it makes sense to me that the Canadian dollar is very weak. We put all of our other resources into making expensive homes, which made everyone feel rich, but actually it made us poorer because we can afford less when we can only afford a home or barely afford a home, and that we can't save for anything else, we can't invest in anything else. So our policies have all gone toward sort of taking for granted that our currency was the commodity space. There was a lot of investment in that into the 2008 peak, as you know, the China belief phase and all that. But I think that the good news for Canada is this protectionist wave that's coming, the United States, et cetera, wanting to onshore, wanting to be closer, that's probably very good for our resource sector. That means that our currency may well appreciate. We may well be near the bottom of where the loonie is here. We know it has only been weaker once in in the 160 range relative to the USD back in the early 2000s in there.
Yeah.
So we could be, our target was 145 for the CAD versus the USD, and we're around there right now. There's a chance that, again, whatever happens this week, it'll give us a sense of how serious the administration, the U.S. administration is about some of these tariff threats. If there's tariffs, we're going to want a weaker Canadian dollar, right? We're going to want to, again, back to what pays our bills. We need to be competitive in something. We aren't manufacturing enough things here. We need to get smarter about, I think, not just providing raw goods, but actually figuring out ways to invest in, like you were mentioning, productivity and business investment. We're definitely in need of that. We need to shift our incentives away from just housing and all these gimmicks about how do we keep house prices high. It's all the wrong thinking in this dynamic, right? So I think the Canadian dollar could weaken more, and we're going to want that. But the good news is, longer term, we're seeing how these policies pan out, at least we're not sitting with tech stocks as our main, tech stocks that 24-year highs in terms of bubble valuations. Again, those companies may do well. That doesn't mean that their stock price won't crash. I think bubbles always crash. That's the nature of them. The good news is that for our mining sector in Canada, we're not facing bubble valuations like we were back in 2007. We have put in a grind sideways for quite a while. So there should be an investment case here that's in conjunction or in collaboration with all those other themes. And I think that's good for Canada. I am concerned, though, it's going to be, as you say, very rough getting there. And I would just caution human beings that we have finite time horizons and we make terrible decisions with money very often based on these macro themes. And if we were pension funds, that would be great, right? Like if the CPP wants to invest for what's going to happen 30 years from now, let's do that. That's awesome. But for an individual, knowing that all stocks go up and down and eventually lose money over time, it's when you get in and when you get out. And very few people think about that. And that's just really hard. It's hard in behavior terms. It's hard in every cycle. So I guess the thing I always want to impart is make sure you understand it's a cycle. Make sure you're not too concentrated in any one thing. Make sure you maintain liquidity. Make sure that you invest in yourself, that you self-insure in every way that you can. And I think those are the ways that we actually power Canada forward. Because we do have a lot of great things going for us, but like the rest of the West, if we're just sort of fat and lazy and complacent with risk because we've been underwritten by everything else, then there's not much power in that.
I love that. I love that. Thank you. Now, the last question I want to ask you is just about wealth management for maybe the balance of this decade. The most popular ideas that are discussed are, pile into NVIDIA stock or buy the Fab Five. Pile into Bitcoin, pile into real estate. These are kind of the main themes that are making headlines right now. Walk my audience through. These are individual retail investors today. Is it time to play defense? Is it time to play offense? What's the portfolio? What should the portfolio look like right now?
Well, it's pretty much always time to play defense for a human being, especially one that's 50 plus. Like this is, again, back to the timeline piece. I know you're really young, Jay, but the rest of us, you don't have that many more cycles left in you to have boom and bust, right? So the thing is, by all means, have an interest, have your passion, follow companies, follow the sectors, the spaces, but always be very careful with what amount of your principal you're allocating to high-risk bets. With the idea of which I just mentioned, most companies will lose you money over time. Most sectors will go through boom and bust. So yes, I think the way to manage it is to have the vast majority of your wealth in the shortest duration, safest things that you can have. Yes, if you can have a roof paid for and that's cost effective and you don't have to pay rent and it doesn't cost you a fortune to keep it, great. That's an awesome thing, is have a roof over your head. Very much awesome. And second thing is to have deposit-bearing instruments, so GICs, short bonds, cash, high-interest savings, liquidity. If you can have a little side hustle even in retirement where you make a few dollars, where you have a bit of expertise, all good. For your high-risk principal or capital that you want to allocate, whether it's in commodities, which is very high risk, or small-cap companies, very high risk. In your own business, that's an excellent place to invest your principal because you have some autonomy over what goes on there. But yes, I think there's going to be lots of opportunity on the riskier stuff. For example, in the American market, which everyone is heavily allocated to today, 70% of equity portfolios are in the S&P 500. I don't think that's going to go well. I don't think it'll go any better than it did in 2007-8 when most people were in venture. So, you have to keep your concentration very minimal because of the fact that you don't have forever.
Chase upside with the minority of your portfolio, put the bulk of it in something stable, generate some yield, retain purchasing power. That's the portfolio.
That's it. That's for life.
I love it. Ladies and gentlemen, Danielle Park.